Markets remain wary of volatility after the VIX eases back from a 4-year high. Welcome to Market Insight. I'm Ludovica Brignola. European stocks extended earlier gains, tracking a global rally across equity markets. Now that the dust has settled after the sharp moves we've seen in the last few days, what does potentially higher volatility ahead mean for asset classes? Well, to help answer all that and more, I'm joined by Ambrose Fawkes, Fund Manager at Artemis Capital. Thank you very much for being with us today. Right, so until not long ago, right, we were in a bad news is good news sort of mood for equity markets. And after Friday, we seem to have moved to a bad news is bad news mindset. First of all, will it last? And what's happening in equity markets?
Well, I think that's a pretty fair characterization. I mean, there's been a vast change in the top-down narrative. We clearly could have seen a little bit of a slowing in the US as the year was progressing, but then clearly last Thursday, that sort of picked up momentum with the ISM manufacturing, particularly the employment part of that, which was much worse. And then clearly on Friday, the non-farm payrolls, things looked even worse. Clearly slight pickup on Monday's ISM services. But frankly, the question that the global markets are asking is, can the US, stand the Fed rate at the sort of 5.3-ish% level? So now we're looking at sort of rate cuts. And, the question is the Fed either cutting to gently get the soft landing that the US economy and the global markets want so much, or actually are they now already behind the curve? So that's clearly had knock-on effects in terms of, sort of European and UK bond markets have fallen by not by the same magnitude, but that then does naturally lead to stock market rotation.
Right, interesting. Now that the dust is settling after the volatility we've seen, where are we now in terms of attractiveness of certain sectors like tech versus more defensive sectors, for instance?
Well, I think with tech, obviously so much of this is tied up with the Mag 7, and there's been a lot of the market's clearly very concentrated around the Mag 7. That's very well known. But I think as results have come in, it's very clear there's been a lot of spending on AI, but little really to show so far in forms of revenues. So this adds slightly to a sort of peak AI narrative, which has caused a momentum trade to somewhat unwind, which has also caught up in it things like sort of Bitcoin and the sort of GLP-1 stocks as well. I think one thing you can't also take away from this is that a lot of these market moves have happened whilst many participants have been away on holiday, so they're being done in thinner volumes, which clearly doesn't help. So we've seen obviously this sharp, as you talked about, cyclicals, versus defensives moves, many standard deviations, but actually this is now throwing up anomalous sort of moves, which we can go through and actually sort of find the opportunities. Many of those we think may be found in actually the UK, long forgotten, but actually, we think a relative source of safety in these markets.
Interesting. And if we were to compare EU financial markets with US financial markets, not just in terms of growth, but also in terms of opportunities there, what would you think? What would be your view?
Well, I think from a political point of view, to start off with, the US still has, two fiscally loose potential presidential candidates, whereas, and that creates sort of political volatility. Whereas in the UK, for example, we actually have, we've had an election, we have 5 years of likely stability, certainly at least after the last 14 years. We also have sort of compare and contrast on sort of savings ratios. So, Europe as well has very high savings ratios, the UK very high at 11.1%, the US on 3.2%. So we have a much richer consumer in Europe and in the UK, which we think again presents opportunities. So within that, actually, there are good opportunities, we think, for, the consumer stocks, and actually also, particularly within the UK for the financial services, particularly the banks, where they remain very cheap. They have very good capital allocation policies, buying back significant amounts of stock at discounts to intrinsic valuations, which will really accrete value powerfully for shareholders.
And Ambrose, you say in your notes that you do like domestic cyclicals, financials, and see headwinds also in consumer discretionary. Why do you see value there right now?
Well, I think it just comes down to the fact that the UK consumer has, a huge amount of savings still, even, post sort of COVID, and even, despite the increase in interest rates, the UK consumer actually has £300 billion more in deposits than they have in borrowings, which really goes back to that sort of mortgage market point. They've managed to weather the increase in interest rates there. So effectively, there's a lot of pent-up ability to spend, and we think we'll continue to see it over the next 2 years. And this amount is very meaningful. It's an 11.1% savings ratio against a 5 to 7% long-term average. As that unwinds, that should release maybe around 60 billion of incremental spending into the economy. So we like the discretionary names, and they also look very cheap to us. And on the financial services, we think that the yield curves are relatively more insulated against other markets. We think the UK banks, for example, are still earning into their full earnings potential due to their very differentiated way of hedging themselves, which means that really it'll take another 2 years for them to actually hit their sort of maximum earnings from the interest rate moves we've had over the last couple of years. And particularly on the banks, they're very cheap and they're buying back huge amounts of stock at significant discounts to their intrinsic value. And in 2 particular cases of Barclays and Standard Chartered, significant discounts to their book values, which is going to really accrete value very quickly and very powerfully for investors who are willing to participate there.
Those are really interesting insights. Ambrose Fawkes from Artemis Capital Management, many thanks for being with us today. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.